We have a pretty packed program today, and I'm going to introduce Bruce Norris. He is the president of the Norris Group. He's been an investor for over 30 years with over 2,000 transactions under his belt. And Bruce Norris.
Thank you. I was going to say, are we on? Okay. My own son downgraded me by 1/10. How many of you are hearing me speak for the first time? I thought there was a lot of new people. Well, thank you for coming. It's going to be a great day. We've compiled what we consider a group of experts that handle different facets of finances for people. I'm an investor. Our company usually buys and sells homes, but I personally have rentals, and I personally have trust deeds, and I used to invest in stocks, and I learned that was a bad match for me because I wasn't in control of things, and my personality wasn't a good fit for it. I don't know if you have stocks, and do you pay attention to them every day? I paid attention to them every hour, and I realized I didn't need that. And so now I have boring rentals and boring trust deeds. When I go on a cruise, I'm relaxed, and I notice that sometimes other people are stressed, and I don't know why until I get back home, and they've been checking their stocks, and something radical has happened. They lost 12% of their net worth while they were on a cruise, and that's a little disappointing, you know? And so the world that we're going to show you today is, in the beginning, my turn, it's really concentrated on the cycle of real estate that we're about to be in. That's what I've taken time to get good at that because I risk my money in a marketplace every day. Last year we bought and sold 150 homes. We have about $45 billion of other people's money in trust deeds. We have a lot of people that are in the buy-sell business and the buy-hold business. So we're up to our eyeballs in real estate. And we better understand what makes that market move price-wise up and down. In 1997, I wrote a report called The California Comeback, Why Prices Will Double in the Next 8 Years. And in 2006, we wrote a report called The California Crash, Why Prices Are Going to Go Through the Floor, and maybe you ought to take some of your chips and go home. We're about to have another direction change. So it's so much fun when you get to talk about something positive. When you write a report called The California Crash, you get invited to places, but it's like, oh, Bruce is here again. We just hope he doesn't say anything too devastating. You're going to like what you hear today, and you know I'm not manufacturing this stuff because it's a business model that I have to create this of success by saying what's coming next, okay? And what's coming next really has surprised me. I did not expect to be saying what I'm going to say today until maybe several years from now, but it's here and it's real. And how I've tried to figure this out, first of all, I was almost forced to figure it out. We buy and sell homes. We usually have a stock of 50 homes that go on a journey through, we bought them, we fix them, and they're for sale in escrow. Usually that's about a third, and a third. And I started noticing a shift to where there was a third and 2/3. We couldn't keep anything for sale. It just went escrow. And we put it in the MLS prior to repair, saying this home is going to get new carpet and new paint and all this stuff. Didn't matter. Offers came in. We went pending. And then they started, as the year started progressing, we started getting multiple offers to such an extent that we started having overbids constantly. Anybody have appraisal problems in this crowd? Yeah, that can happen. So we actually added an addendum in some cities that we knew there was enough money to withstand this, and it says the appraisal will no longer determine the sale price. So in other words, you're the winning bidder. You overbid everyone else by 25 grand. Congratulations, the home is yours, but when the appraisal comes in low, be prepared to come in with the extra money. And they have. And so I looked at that and said, okay, what is going on? Because this is different than what I would have expected. And so I went back to my charts, and I'll share that with you. And then with that understanding, what investors are doing and why trust deeds are a safe place to put your money. We have a radio show, I guess since there's so many people, we have a radio show that you should maybe take a listen to. Friday night of last week, we had our annual event for fundraising. We raised $77,000 for charity. Yay! On the panel were experts from each of the facets of the real estate industry, president of the National Association of Realtors, Mortgage Bankers Association, Appraisal Institute. These are the people that are going to be in front of Congress and lobbying for what goes on in our industry going forward. And those are the types of people we interview on the radio show. So I don't think anybody listens to it on the radio anymore. You just go to our website and you download whatever kind of file you get and put it on your iPad. And you can tell that I can't do that, but I know you probably know how to do that. You can listen to it, and you can listen to any one of almost 300 shows to your heart's content, okay? Our basic business model is we take this house and we turn it into a nicer house. Our industry sometimes gets we get bad press because they think we get this house and we keep it that way and we rent it out and we don't do anything to it. And they think that if investors buy all this stuff, neighborhoods decline. Well, just so you know, that's what we do to our rentals. That's how we fix our rentals. We had Nightline go through our homes one afternoon, and they went in the before and then the repaired version of other homes, and they came away with a very different opinion of what investors did for a marketplace, and that was fun. One of the problems for California is this is a real deal. This home sold for $356,000 at the peak. We bought it pretty much at the bottom for just a little less than that, $65,000. Put money in it, and we kept it as a rental. And that's one of the things that started to make sense in California, really for the first time in a long time, is you could keep a rental, and it had positive cash flow. Before, when you're an investor and you kept a rental, you either had a boatload of money into it so it would break even, or you had negative cash flow waiting for escalation of equity. But all of a sudden, these things started cash flowing, and investors wanted to buy them. So coinciding with that, was the government ready to loan to investors? Not at all. And so that is how the private loan emerged, the necessary loan for us to be able to buy and hold properties. We've had to fund privately. These are a series of charts and how I try to figure out what's coming next. Interest rates, it's hard to keep up with this chart. I went into B of A probably last week on Wednesday. 30-year mortgage was 3.25%. Sean O'Toole and I just went back to Washington, D.C., two nerds looking at statistics at the Library of Congress. Doesn't that sound like a fun 3-day trip? Well, that's what we did. And one of the things we wanted to do is we wanted to look at the history of available loans from 1850 on and interest rates. So, you know, when you see articles and you see, okay, interest rates haven't been this low for 50 years. And then you find out the data source only goes back 50 years. Well, I can tell you that interest rates have not been this low anytime 1900 on. So this is the lowest interest rates that anybody that's alive has ever seen. And it's a game changer and unprecedented. That's a word that's going to apply to a few of these charts, unprecedented. And one of the things it does is it allows for a price change without paying much for it on a monthly basis. So if you have a $50,000 price increase, and let's just make it simple, and you're at a 3% mortgage rate, how much is that a year? $1,500? Divide that by 12. What did a 50 grand price increase change your payment by? Not a lot. And so what I think is coming is a unprecedented escalation of price. And it's because of a couple of factors, and we'll take a look at all those right now. What has happened is that creates affordability. So we're at the highest affordability number in history, which means that housing takes the least of your income ever to own it. That doesn't always mean that everybody wants one, by the way, because the mood is also at the bottom. But now we're starting to have that make a comeback as well. So this is what took place, and all of the policies that started to play with what should have happened. They needed it not to occur by natural causes. This is a progression of delinquencies, and we just soared. If you take a look at the gold line, that's the number of trustee sales, the number of foreclosures. This has a relation, usually 2/4 after a default, a foreclosure occurs. So there's a mathematical correlation. 4.2 delinquencies resulted in 1.2% foreclosures. And if you take that, you should have 11.3 delinquencies add up to something very different than 0.8 foreclosures. It should add up to this. But what happened when they started foreclosing on all these properties, there was 25 months of inventory all of a sudden in the MLS. And people like us were buying properties at 20 cents on the dollar what the lender was owed. So if they were owed 300 grand, they were getting 60. When you start losing 240 grand a pop on loans, guess what? You want that to stop and maybe recalibrate what you do. Ironically, their aggression in 2008 and 9 has set up kind of an amazing scenario that I know they didn't actually think about, and we'll get to that later in the talk. So the games began in 2008. They've never really stopped. The foreclosures that should have been up here have constantly declined, and recent decisions have made me absolutely sure that they're going to decline and be a very small piece of our market. So that term shadow inventory is actually a real term. All of this inventory never got foreclosed on and is churning in the background, and we've been waiting. Maybe it's 2012. No, it's after the election. You know what it is? It's not. It's not going to show up. They have figured out how to get it on the sidelines and pretend it doesn't exist. Isn't that cool? It isn't. It's silly, but guess what? As long as that's the game plan, we can take advantage of it, okay? And that's the game plan. How many of you have received your 150,000 people in California received a letter from B of A saying you no longer owe anything on your credit line? How many of you got that letter? You got the letter? Is it true? Okay, I didn't expect anybody. And I was so excited when I got home. I had a letter from B of A. And I'm just kidding. It was something else. It wasn't that. But that's what they've done. They said, okay, 150,000 people. As a matter of fact, here's something funny. They had mailed the mailer telling people that we're going to give you a principal reduction, but they said only 7, and they even gave the amount on the letter, only 7% of the people called B of A back because they stopped opening B of A mail. So this mailer went out and said, you have to call us within 30 days to prevent the forgiveness of debt. So it increased their odds a great deal. So that's how they got that accomplished. That's what's going on. We're going to see more and more games being played for people to stay in their homes. The amount of REOs is down 36% year over year. This is the real factor that I started looking at. This is the number of homes for sale of any kind, of any mix, in this thing called Inland Valley region, and that's some of Orange County, some of LA County, San Bernardino, and Riverside. And this quantity of homes available includes private sellers doing regular sales, short sales, investor sales, every kind of sale, and it's declining and declining and declining. And this is Riverside's inventory, gone from 6 months to 1 month. So no wonder people are making offers on my houses. There's nothing for sale. And what happens is if you're a realtor and you have a private client that's looking for a home, you're making an offer, and all of a sudden, well, I talked to Mike Novak-Smith, one of the large REO agents, one of the largest in the country. He said on one of his listings recently, he had 94 offers in the first day. The winning bidder was one of these multi-billion-dollar hedge funds that outbid every owner-occupant, and their proof of cash letter said they had $193 million to close the purchase. Now, if you were a seller, wouldn't that be tempting to take that offer? It's probably going to close. And you say, no, I'm going to go with this FHA buyer, and we have to go through the hassle of an appraiser, an appraisal review. So a lot of people are just saying, no, that's okay. We'll sell it to a hedge fund. Well, that has changed the game. There's a lot of inventory that's disappearing. Are these guys selling the property, these hedge funds? No, it's on the sidelines as a rental. So the first time ever, we have a market maker, not just one of these companies, half a dozen, maybe up to 10, in our marketplace with $1 billion to $5 billion that are buying houses not because they want to resell them, it's because they want to put them in a REIT. And because our area is inexpensive enough, it makes a cap rate that makes sense. So that's all of a sudden becoming a competitor. So it's starting to get inventory to be gone and prices to firm up. At the same time, the lenders seem to be more skittish than ever to make a loan. So here's a good thing to see. 45% of loans FHA made in 2007, 619 FICO score and above, 45%, that was the percentage of the loans. Now, 3%. That is one big change. So they are not making loans to people like they were. Fannie and Freddie is the same thing. In 2004, 5, 6, and 7, they were making about 37, 38% of the loans to 700 FICO scores and under, and now it's 9%. So the game has changed just when there's no inventory, and maybe a lot of owner-occupants would want the property. It's becoming much more difficult. All of these games are being played to make this big pile of debt feel less cumbersome. When we were, let me see if I have the price chart. When we were at this price at the bottom in early 2009, 245, we were revisiting a price we hadn't seen since somewhere around 2000. And this is why that's significant. Uh-oh, I went the wrong way. Okay. If you go up from here at 2000, we probably owed about $5 trillion of debt on the real estate. And then prices went up, and then they came down. When they came down, this debt didn't come down, just the price. So we actually owed $5 trillion more on the value that existed in 2000. That's a little bit of a problem. So you just say, well, the banks have already written that off. No, they haven't written off anything that starts with a T. That's a lot. A B, yes, but not a T. So all the policies that you've seen over the last 3 or 4 years has tried to figure out how to do one of two things, how to get it to come down by forgiveness or foreclosure, or what if you could get prices to go up to where all of a sudden this didn't feel so bad? Well, we've gone from 245 to 340, and now we're mimicking 2002 and a half, and all of a sudden this debt is, we've covered $6 trillion of it, and as if we can get prices up to 2004 and 5 levels, we'll be 80% of the way there. That's what you're about to see played out, because it saves the industry trillions of dollars, okay? So that's a game changer for investors, okay? And it also makes trust deed investing, and by the way, we hardly have any problems anyway, but when you have escalating prices in a trust deed on a property, it keeps becoming less and less of an LTV. So all the trust deeds that I hold all the ones in an 8-year program. So let's say we started at 60 cents on the dollar and these prices start escalating. I'm probably already at 45%, and at some point I'll probably be at 30%. You know, I'm not stressed about somebody not making a payment, let's put it that way. Okay. Now, if you're going to solve the problem from the bottom up, how you do that is a couple of things. First of all, make the payments ridiculously low. So that's what's gone on with this very low interest rate. In the Inland Empire, you actually save $6,850 a year by owning over renting. You can't have, that sentence could have never been said before. So I'm a pretty common sense guy. All things being equal, wouldn't most of us rather own than rent? What if you could save $500 a month to own over rent? We had a meeting yesterday, and the guy, a very knowledgeable guy, was telling me that the emotional impact of the loss they just suffered 3 or 4 years ago is too much. They're not going to re-enter buying. I'm a practical guy. You know, I could be all upset, but if somebody's going to save me $500 a month to own rather than rent and fix my payment for a long time, I'd probably sign up for that again if they'd let me in. And so I think that's what's going to start happening. The other investments are kind of volatile. There's some people just like me that have some gray hair here. What if I open this up and say, I have a really great investment for you, and you'll be so excited to hear that it's really volatile? You know, that's really not what a lot of us want at this stage. We really don't want that, but most investments are. So you see a stock chart, and it's doing this, and somebody does something wrong over in Greece, and your stock portfolios go down. It doesn't feel like you're in a lot of control. If you're really conservative, you have a 10-year T-bill, and you get 1.8% on your money doing that. So it's not the easiest environment to get a yield, and I'm just so glad we have this little world, what's is considered an alternative investments, because it's there where if you know anything about real estate and you've ever borrowed money, it's very easy to understand what a first trust deed is, and it's very easy to understand what a rental is. Again, if you want to have the price to go up, you just take inventory off the marketplace. How about adding several $1 billion into the marketplace? And we just talked about that, where companies are buying to hold properties. That's happening. Instead of foreclosing, FHA is intending to sell the loans in bulk. So they have a lot of people late, but very few of those are going to filter into a big pile of HUD REOs, where remember in the 90s we attended HUD auctions? We ain't going to attend HUD auctions anymore, because they're going to be selling these note pools. And when they sell the note pool, there's instructions. It says, don't foreclose on these people. You can't foreclose on half of them. You have to recast half the loans, and the other half, you can't even start the foreclosure until 6 months after the deal closes. So we have managed to kick the can so far down the road, I don't think the road is going to end. It's just going to be a way to support prices and solve it in another way. Sell existing homes in bulk. So Fannie Mae has sold bulk pools now. Now, that has been contested by CAR. That may stop. It's still not a significant enough amount of homes to be a market changer. Taking deed in lieu of foreclosure. So if you're in trouble, haven't made your payment in 3 years, by the way, that is almost common now. So take a deed in lieu of foreclosure, just rent the house from us. You don't have to move, you don't have a foreclosure, and I'll bet you someday they get an option to buy that very same house back. So that's another plan. And at the same time, let's don't build anything. That'd be terrible. So did you hear the building's way up? I really kind of laughed at that. Building is way up. So it's up 17%. So add 17% to that. You could add 300% to it and you would get to there. So statistics are kind of dangerous. They make it sound like a big deal. I think in Riverside that meant they started 17 homes. So we go, wow, that's a big deal. No, it's really not, because we can get here, and we're here. And if you think builders are optimistic, I have a really good barometer for their true optimism. It's called how many subdivisions are they creating? So here's what they were creating. Here's what they are creating. I think they're making a mistake, by the way, because I think there's going to be a very big housing shortage for all these policies are creating a bunch of properties on the sidelines, and you're going to have a hole. Now, how quickly can you create a subdivision? Let's say you want to go back to normal and have 300 subdivisions approved, ready to build on. Is that 6 months? Is it 2 years? 2 to 3 to 4 years, maybe, depending on where it is? There's a big builder that had just had a project denied because of some type of environmental issue. They're now on a 3-year journey to solve that. So you don't get building lots tomorrow. So it's a little hard to catch up in this category. The lenders are doing everything they can to also work with people, and this is the new letter from Chase. To provide relief more quickly, Chase executives are addressing the borrower fatigue with a letter sent to borrowers notifying them that their loan was refinanced into a new mortgage with a lower interest rate. No documentation needed. You don't even have to give them permission. All you have to do is open your letter. You know, let's say you're writing a check that's your normal payment. You're probably overpaying. You have a whole new loan. You know what the new interest rate is on these loan mods? 2%. I mean, that'll work monthly, right? I want one too. I want to take them over subject to, though. Aha, we'll do that. Okay, and then they have another letter for, this is more difficult if you go on a principal reduction. Chase is sending different letters to other underwater borrowers. All that's required in order for a principal reduction on their loan is a signature sent back with a self-addressed stamped envelope to the bank provides. So that's your principal reduction now, is reduced to reading your mail and signing something and mailing it back in. So they're trying to do this all at the same time. So they're forgiving debt, doing a short sale, and they'll even pay the former owner to cooperate with the short sale. I'll give you an example. In Moreno Valley, there was a $225,000 loan on what is now about $100,000 two-bedroom house. But the person was current, cooperated with a short sale, got paid $25,000 for cooperating. The lender, after closing costs, netted $23,000 after the sale. They netted less than the person was given to cooperate. Now, here's a good question. Is that person capable of buying tomorrow? Yes, because they were current before the short sale. They can get an FHA loan. Do they have the down payment? Yeah, we gave it to them. They're all set to go. They can buy the next door house. Cut their housing costs by, what, over half? So that's what's going on. All this inventory that was supposed to show up and be shadow inventory problem, it's not going to happen. So this mix of sales, which was really dominated by this and this is going to grow. This is going to shrink some more. This is going to try and grow. And as a percentage, it will, but maybe the numbers won't be sufficient because a lot of people are still upside down. Not everybody's going to cooperate with a short sale. They don't want to move. So you're going to have a lot of buyers perhaps, but you're not going to have an enormous amount of inventory. So when you hear statistics saying sales are down, that can sound threatening. It's because there's not enough inventory that can show up right now. All of the policies are dictating that inventory does not show up. So when you have mom and pop looking for a house, getting overbid by hedge funds, and they try to buy a house every day and offer full price for 25 days in a row, guess what happens on the 26th day? Do you quit? Some of them might, but here's what happens. Your wife goes like this, honey, I really want this house. Pressure's on, so you overbid an astonishing amount. So you're the winning bidder, yay. And now you have to cough up maybe 30 grand more than you thought. Have you made a mistake? No, you probably made a very smart decision because if that translated into loan, 30 grand at 3%, what did it cost you? $8? Okay, that's why, and this is unprecedented, a price increase has never cost so little to a budget. And we're starting at a very low point. We're already the cheapest monthly payment ever in history, and now we're going to have a chance to have this price increase, and it's not going to feel very bad monthly. So it's going to be interesting how aggressive it is. This is the piece that I finally put together that made me feel comfortable that this rally has legs. And it was when I decided to look at the 2008 and 9 numbers and say, how many people did we foreclose on in 2008 and 9? We foreclosed in Riverside 61,588, and we sold 37,173 homes in 2011. So I use that number every time I'm going to use this example, but this is 165% of that number. 3 years after your foreclosure is complete, you can buy with an FHA loan. So on top of normal market demand, on top of investor demand like us, on top of hedge fund demand, you have 165% of an entire year's volume that used to be owners that might want in because it saves them money monthly to re-own. And at that exact time, what have you done to inventory? You've taken it from 6 months to 1 month. I like the word inevitable. It's inevitable you are going to have a price increase with that scenario. Now, next year, the percentages decline, so this number of people that could reemerge in 2013 are only 65% of a year's volume. But you didn't solve this one. So this is now on top of this, going into 2013, a big pile of people that might want something with the lowest interest rates in history. So I'm excited. Excited enough that I'm going to make every effort to buy 300 and some building lots next week. Now, somebody's going to sell those to me because they think that's a really good decision on their part. They have $32 million in this project, and they're trying to get 6. 20 cents on the dollar, because I think remember that chart I showed you about creating new building lots, subdivisions? That's where their mood is. This isn't coming back. Well, I beg to differ with you. I bet you within a year they're going to go, well, we got to go create building lots. And it's going to cost them $32 million to do that. And I'm going to own it for 6, I hope. That's going to be fun. That's the advantage of seeing in advance what's going to happen inevitably, okay? San Bernardino even is worse. This is 2 times the number for a year sales. So San Bernardino, who came out with the idea of let's do eminent domain, You got to be kidding me. You have so much demand for your product waiting in the wings. You don't need to do anything other than just let the market work. So where's the inventory going to come from? So we're down to a month's inventory. Is it going to come from REOs? One of the interviews we did on the radio show was 3 local REO agents that are very established, some of them the largest in the country. Are they being told to staff up after the election, after the beginning of the year, we're going to load you up with inventory? No, they're being told, you can lay your staff off. That is not how this is going to play out. So people that had 600, 700 listings now get 2 assignments a week. They're down 99%. So if you thought it was going to come from there, it's not. Private owners with equity, yes, as prices escalate, those will show up. Not in sufficient quantity. Short sale, yeah. But it's an interesting thing. Short sale owners, who would be the prime candidates, you're upside down, you're late. If they're late by 2 or 3 years, what have they been accustomed to doing? Not having a house payment, living there for free. That's a hard habit to break. So someone knocks on your door and says, you know what, we could straighten this whole mess out, and you could leave here and go pay rent somewhere. You're like, that sounds ugly. I don't want to do that. And so a lot of times the people that you think would sign up for it, they don't. Investor flips. A lot of investor flips are turning into investor holds because it makes the margins have shrunk, but it still makes sense monthly. So you buy the thing, and all of a sudden you're holding it instead, getting cash flow and waiting for the prices to escalate. So a lot of the flips didn't happen. So this inventory is getting smaller and smaller. New construction can't catch up that fast. So where the inventory going to come from? It's not. So you're going to have an escalation of price. And when that happens, it makes our whole world safer. That's why I'm excited about this. I need to get to the point about probably some trust deed investing. Aaron, I'm sorry, what time do we have? What time is it? Pardon me? 15 minutes. Okay, yeah, I guess I better get to why we're here. Okay. You guys can hear this later, and actually you can look at it later too. Yeah, I overdid the first half of this, but I do want to talk about the trust deeds. Is this the right one, Aaron? I don't think this is the right one, buddy. I don't think we have the trust deeds one on here. Yeah, this is not the correct one. One moment while I sing and dance, okay? I can tell you what happens in a market that we're about to see. People that are on the sidelines are going to start hearing stories from neighbors. We have somebody at our work, and just to show you what's happened in her world as she bought her home. She had a divorce, and then she got to buy a home in February for $205,000. And in 7 months, it went up to $285,000. And she refied. She got rid of PMI. She has a big pile of equity. And then she has enough money monthly to go buy a car. And the car cost still doesn't make up the difference in the loan savings. So she actually got basically a free car, and now she's got a big pile of equity. When that happens to enough people, you start talking. And that starts changing a marketplace. And so that's what's, up until now, all we've heard is bad news. All the stuff is, some of it's true. That really has been true. But now you're going to start hearing positive things. And when you start hearing positive things, all of a sudden you have a lot more interest in a marketplace. Now, could she be a move-up buyer? Yeah, she got changed from a non-owner to a move-up buyer in 7 months because she has equity. So that's what also starts to happen. So we start to see a big shift in what happens in the marketplace. Oh, you even pegged it right where I need to be. Okay, let me see what was before that. Okay. So the first word on trust deed investments, by the way, a trust deed investment is basically you're just a bank. And our clientele that borrows the money is an investor that is either going to buy and sell the property or buy and hold it. The buy and hold trust deed is an 8-year plan, and the person that buys the property pays 9.9% interest, and the investor in the trust deed gets 9%. I like this trust deed for me personally because it's an 8-year commitment, and I don't have to think about it. If I invest in the other trust deeds, I have to make a new decision every 6 months because I get paid back and then I have to do another trust deed. It's a higher interest rate, but to be honest with you, I don't want to do that all the time. So I have trust deeds that you get used to it. I can just tell you, when you're on vacation and you come home and there's a check there, you kind of get used to that, and it is very passive. Now, I own rentals. So I was on a recent cruise, and I came home, and there was virtually a tornado next to one of my rentals. Took out the entire fence, and then an air conditioning went out. So I had $3,000 or $4,000 of expenses I didn't expect on my rentals while I was on a cruise. When I came back, nothing at all happened to my trust deeds, because I wasn't responsible for those houses. They just had to make me a payment. So that's the passive nature of a trust deed investment. We consider them extremely safe because of who we're loaning to. We're loaning to investors with experience that have a profit motive. They have money in the deal, and they very, very rarely go bad. It's a very good yield, considering the risks especially. Investing in something you understand and can solve. I own Juniper stock, and on Friday night, they told us the CEO did something wrong. And in the morning on Monday, guess what happened to my stock? It was crushed. Now, could I sell it on Saturday? Did they tell us in business hours on Friday so I could get rid of it? No, they couldn't do that. So on Monday, I was worth half as much in my Juniper stock, and I didn't do anything wrong, and I couldn't have solved it. And I like trust deeds because, first of all, it's against something I understand. I can stand in front of a house and go, okay, I get this. I'm the lender on this house. Worst case scenario is I foreclose and I own the house free and clear because I have a first trust deed. Well, I get that too because I have rentals. Fortunately, the way this is arranged, your trust deed is probably paying you 9% interest in, say, $500 a month, and he's collecting $1,000. So again, your worst case scenario is, okay, I go through a little hassle and expensive foreclosure, and then I get a $1,000 check instead of $500, and I have to pay taxes and insurance. So is that the worst exchange in the world? I mean, that's your worst case scenario, and you go, okay, the worst case scenario is not so bad. Maybe you don't want to root for people to do that, by the way, but you could see that it's safe. So that's why I like it. It is a little boring compared to rentals. Here's an example, and this is home in Compton. We have areas in Compton that are perfectly fine. We have people that are very good, very experienced. Appraised value $232. The loan amount was $140. It's at 60% loan to value. The payment to the trust deed holder, the investor, is $1,050, and they collect $2,000 in rent. So as you can see, it's a nice fixed-up home, 3-bedroom, 1-bath. The homes that you see as rentals, they're not going to be in Balboa Park. This is rental inventory. So don't get shook up if you go, well, I don't know that I would live there. We're not asking you to do that. Okay, Moreno Valley, appraised value 101. Now, what's interesting about this is, again, this price could start changing again pretty rapidly. Right now, we're at 62% on this trust deed. Payment to the investor is $472. The rent's $1,050. So it's just, again, a very repetitive thing. Hesperia, $87,000 value, 54 grand loan, 62%. 405 payment, $1,000 in rent. Nice lawn, right? Has potential. See, I wouldn't necessarily be afraid of that as a trust deed investor. I would not. This is all improving now, and that's important. So all of these delinquencies, the future problems are diminishing and getting back to manageable. So all the stuff that we had to deal with was shadow inventory. How do we get rid of that big ball of problems in the back? We've decided to send it to the sidelines with all the programs that I just mentioned. So that shadow inventory is not going to show up. What happens when you start to have building going on in Riverside is you attract migration. So I think what's about to happen is we're going to have a need for building, and you're going to end up having a lot of people show up in Riverside. So this has been at a very low, much lower level than it usually is. When you start having this type of migration, you have a lot of demand for a product called real estate. San Bernardino had been negative. We're about to see this chart again for them. Just in trends in general, we have this fear that the baby boom generation is going to retire and throw out all kinds of homes into the marketplace, and there'll be more homes for sale than are being bought. And so doing research on that, this chart shows, this is the number of baby boomers that are, let's see how old they are. This is a 40, you had 42 to 1970. You end up, this group of people right here is now turning 62 to 66, and the quantity is 17 million. This number here, if you add 42 to, you add 7 to that, they're 27 to 31. This is called the baby echo boom generation, and they dwarf this generation by millions of people, maybe 3 3/4. Those are the people that are going to take the place of the baby boom generation. As they retire and they say, I don't want this house anymore, the baby boom generation is dwarfed by the echo boom generation. And a couple odd things about the echo boom generation is that they have different habits than any other generation before. They don't want to get married till they're like 28 or 29. And maybe some of you guys still have some of those people living in your back bedroom. They did that for a lot longer than any other generation. My generation typically got married at 22. I got married at 17. There wasn't a chart for that. But this generation is waited to get married. They're about to become households. And then when you have a bad economy, it also stifles household growth. So you've had negative household growth that's about to come out and say, we want to live on our own. You also have people that have gone and lived together, sometimes in your rentals without you knowing it, right? How many people are here? Oh, my goodness. Okay. So they don't want to live there. They want to live on their own, and they're about to do that. So we have household demand that's been pent up, but the numbers, even if it wasn't pent up, will be very positive for real estate. The future of California is interesting. We get afraid sometimes we hear about the budget deficit in California, and, we're just going to have to declare bankruptcy and stuff. This is an interesting chart. This has to do with risk capital and where it gets sent. So this is venture capital, and then the brown is California. Now, there are 50 states in the country, and we get about around half of all the venture capital that's invested in the country comes here. Now, that's some pretty bright people making decisions that if they're going to risk their capital, half of it's going to be in California. The only thing that we've needed in California is normally the way a California comeback works is you go from construction improving, that improves employment, that attracts migration, and when those dominoes fall for real, then you have a boom. And it booms until we max ourselves out and can't afford the monthly payment anymore in real estate. This time, it's been orchestrated differently. So we really didn't have construction first. What we had is a bunch of homes that should have been put up for sale. They decided not to. So they artificially created a housing shortage, which is why we're at 1 month of inventory. We're going to have prices accelerate to where a builder starts looking at those lots that they own already and go, oh my goodness, it pencils. So they're going to start building. And once they start building, they're going to start hiring people. Unemployment's better. Migration happens. And once you have migration here, all of a sudden you have a whole other budget picture because you have a lot more revenue than you thought you were going to have. And it solves itself. So I think we're about to experience a very different cycle than we thought was coming for California. And I think it's going to heal itself because we're going to get a lot of people show up because it makes perfect sense. And all things being equal, California attracts a lot of people because of all the things we have. And that's what's about to happen. So being a trusted investor in California for the next number of years is going to feel very safe. And being an investor, it's going to now switch. So when you are investing in trust deeds, you'll know that you're going to start seeing things like, oh, they're adding square footage to a house. See, that's one of the niches you do. So you take a 2-bedroom, 1-bath and expand it to 3 and 2. And if you have a trust deed on that, you're going to end up being against property that's going to be worth a lot more when that project is done. We're going to start doing a lot of construction loans with private funding because it's still very difficult to get funding if you're an investor. That door hasn't opened wide, and it probably won't for a while. We're still arm wrestling with all the Dodd-Frank and what that means, and so the lenders are still in very conservative mode. And so that's going to continue. So the private funding world is going to flourish and be one of the sources that provides available funding for projects and available revenue for people that have money. It's one of the rare times where you can look at a scenario and say, there are smart people on both sides of that transaction. There's a person with $1 million that instead of getting paid 1.8% on a T-bill or risking the $1 million in principal going up and down in a stock market, they can get a 9% yield, and you could see why somebody wants to buy a rental that cash flows and even borrow money at 9.9% because the price escalation is going to make that a moot point. So it's one of those times where all this makes sense, and both sides have made a good decision. And a lot of people making simultaneous decisions. I don't want all rental property. I don't want all trust deeds. I like to have the blend. And so, that's where a lot of people end up. They land on some combination of that. I've got just a couple more minutes. I'll open up for questions. Anybody have a question? Yes.
Thank you. Do you see this as affecting other states in the West?
Okay.
Well?
Do I see this as affecting other states in the West? That is such a good question. I don't, and I think this is what's interesting. This big hedge fund money, and as a matter of fact, I'm glad you mentioned that too, because I got to refine what I said. This big glut of buyers is because people that were foreclosed on are reemerging in the market. What loan can they get? They can get an FHA loan. So whatever the FHA parameters are is where you're going to have this boom, because that's where the demand is, okay? So in Riverside County, what's an FHA loan max? 500 grand. So that's great. You know what it was the last time we were at 340,000 median price, by the way? 160. So the one thing you don't want to hear is FHA is reverting to its old loan amount. Uh-oh. That would not be good. What's going to also happen is maybe there's going to be some threat from Europe, and they might go into a recession. And it would not surprise me to see interest rates start with a 2 before this is all over. But California will be in the middle of a boom. We will be actually doing the other cycle and not need anybody's help, and we're going to get it anyway. Isn't that nice? We're going to be like the lone Mohican having, woohoo, where else is there 1 month of inventory? See, it all boils down to making a common sense decision. You have all these buyers on top of 1 month of inventory. What do you think is going to happen? Especially when it converts to nothing monthly. That's exciting. Okay, I can take one more question, or Diana, what?
Just want to get them online.
Okay, we probably almost out of time. I'll take one more question. Yes. And by the way, I'm going to be here, so at the end of other people's talk, and I think we'll have a break. Is that probably true? Diana, are we taking a break in between speakers? Talkers. Great way to end my speech, huh? Go ahead.
Everything you've talked about is predicated on, low interest rates. And my one concern with all the cheap money from the Fed is that we're going to get inflation, and inevitably interest rates are going to rise. So, what spin will that put on this whole cycle that you're looking at here?
I think if those interest rates go up more quickly than later, it would probably be pretty benign. Interest rates, by the way, going up don't necessarily affect real estate prices negatively. Give you a quick picture of that. 1974 to 1980, interest rates went from 7.5 to 15. Prices tripled in those years. So interest rates going up don't necessarily damage real estate. It depends on the affordability. So we have a record room to boom in affordability. We can lose affordability for a long time before it becomes a problem. So I'm not that afraid of that, because as a trust deed investor, what I'm loaning at right now is going to go up in value an awful lot. And even if it comes down somewhat, they're never going to let this happen again in our lifetime where you have a price accelerate that has to lose 50% of its value to make sense. That they're not going to do, okay? Now, we may have a 1990s downturn where you lose 5% or something in a year. That doesn't matter, especially after an escalation like we're going to have. That's not going to be a big deal. The investor that we're loaning to starts out with a 40% equity position approximately, and that's safe, and it gets safer later. So I'm very comfortable with this whole scenario. Now, if you ask me that 7 years from now and I see that we've maxed out in everything, then I would tell everybody that owns it, I'd say I'd sell the house. And then you get paid off and we'll find another game to do. Okay?